Please stand by. Well, ladies and gentlemen, good day and welcome to Foley's Employee Benefits Broadcast Conference Call. Please note today's conference is being recorded. At this time, I would like to turn the conference over to Lee Riley. Please go ahead.
Thank you. And welcome everybody to the spring edition of Foley's Employee Benefits Broadcast, the benefit news you need in 60 minutes or less. Before we get started with our presentation, we will run through a few housekeeping issues that will be helpful to you. If during the presentation you have any problem with either the computer connection or the sound, please call 888-569-3848 for assistance. Normally, we try to keep some time at the end of our presentation to allow the listeners to write in some questions, but because we do have so much material today, we unfortunately won't have time for that. So if you have questions about anything we've talked about, please contact your Foley attorney for assistance. If you want to maximize the PowerPoint, there is a full screen button at the top of your screen. And if you want to download and print the presentation, you will see a download files button located to the right. Foley will be applying for HRCI and CLE credit after the web conference. So if you did not supply your CLE information upon registration, please email it to jpolson, P-O-L-S-O-N, @foley.com. And finally, if you are applying for CLE credit in New York and New Jersey, I will be giving you a 5-digit code during the presentation. You'll need to write that down, email it to jpolson@foley.com to get your CLE form. Today I am joined by 3 of my brilliant colleagues, Eric Vogt, Belinda Morgan, and Lori Taylor. And we are going to be talking about one and only one very important topic. If you've gone to our webinars in the past, you normally know that we talk about 3 to 5 different topics of interest to benefit plan sponsors. But today, it's only one thing, and it's all about the employer shared responsibility rules under the Affordable Care Act. So we'll go through what are the effective dates, which employers need to comply with the law, what's the cost of not complying, what does it mean to offer coverage to your full-time employees, which is one of the requirements, what does it mean to offer coverage that is affordable and that provides minimum value, that's the second major part of the law. And then we'll wrap it up at the end with just some of our thoughts about if we were sitting in your shoes, how would we approach this new law and thinking about what do we need to do to comply or not comply. So let's start with the most basic item. When is the law effective? In general, the new law is effective on January 1, 2014. However, unlike many of our benefit-related laws that we've had in the past, there is no extended or delayed effective date for union employees. Accordingly, if you do have union employees, you'll need to check the terms of your collective bargaining agreement to see if there are any impediments in that agreement to your compliance. If there are, you might have to negotiate with the union to change the terms of your bargaining agreement. If you have a non-calendar year plan called a fiscal year plan, there are 2 special delayed effective dates that you might be able to take advantage of. Note that these delayed effective dates only apply if your plan was run on a fiscal year basis as of December 27th, 2012. So the first delayed effective date gives you a complete delay of all the shared responsibility requirements until the first day of your 2014 plan year. Now this delay applies only if you either offered coverage to 1/3 of your employees during the open enrollment period that occurred before December 27th of last year, or you actually covered at least 1/4 of your employees under your health plan, and you can measure that at any point between October 31 and December 27th of last year. If you meet either of these requirements, you do not have to comply with the rules we'll be discussing until the first day of your 2014 plan year. Now the second delayed effective date is much more narrow in scope. Basically, you don't have to offer the minimum value or affordable coverage to any employees who qualified for your health plan based on your eligibility rules as they existed on December 27th of last year. So basically what this means is on January 1, for those people who are enrolled in your plan, you don't have to change the type of coverage you're providing them. You don't have to redo your premiums for them. But for anyone else who isn't normally eligible for your plan, but would be because of the new law, you might have to offer coverage to them on January 1. Now, let's move on to which employers are subject to the law, and only an applicable large employer has to comply with the law. So you are considered a large employer for a given year if you employed 50 or more full-time employees and equivalents during the prior calendar year. So 2013 is a very important year because this becomes your measuring year to figure out whether you're subject to the law starting in 2014. Now note there is a special rule that only applies for 2013. Instead of looking at whether I employed 50 or more full-time employees on average during all of 2013, I am allowed to pick any continuous 6-month period during 2013 and measure my 50 employee rule during that more limited time period. What is very important to understand is that this 50 full-time employee and equivalent test is determined on a controlled group or affiliated service group basis. Now these control group and affiliated service group rules are very complex, and so if you have any doubts about whether these rules apply to you, we strongly recommend you consult with your ERISA counsel. But in a nutshell, here's what they say. You're a controlled group if there is a group of entities that is connected through 80% or greater ownership. Now, if you're a not-for-profit, you look at 80% or more of the control of the board of the not-for-profit entity. It also is important to realize this doesn't have to just be a single owner. In the controlled group rules, there is a concept that you might have 5 or fewer individuals who collectively own 80% of multiple entities, and if that's the case, in general, that all those entities are going to be part of a control group. So in other words, if you have a single owner and they own 2 entities, and each entity employs 40 full-time employees, that's treated as one big employer for purposes of this law. That one big employer is deemed to have 80 full-time employees, and it will be subject to the law. Now, the affiliated service groups rules, again, are very complex. Generally, it deals with entities if they have a management services company or service organizations like doctors and lawyers and accountants and entities that are related to them. So now that you identify, one other point about this. Many of you on the phone probably have hundreds and or thousands of employees, and so you may not be paying attention to this segment at all. I would recommend, if you're in that case, that you pull a copy of your corporation's organization chart to just check that there isn't some subsidiary that is sort of down at the bottom of the chain that maybe has its own health plan, and you've let them keep their own health plan because that was economically what worked for them, and maybe they have 30 employees. So you might be aware that you're subject to the law, but that little entity sitting out there that's sort of been operating on its own may not even realize it's part of a control group and that it needs to pay attention to the law. So this is where these rules are important for you. So once you identify everyone in your control group or your affiliated service group, the next thing you look at is, do I have 50 full-time employees and full-time equivalents? So for this test, you look at your common law employees, and basically on a month-by-month basis, and again, it's either the 12 months of 2013 or you can pick 6 continuous months, you look at everybody in that month that averaged 30 or more hours per week, and that is your number of full-time employees. You then take everybody else, add up all of their hours, and you divide that by 120. That becomes your number of full-time equivalents. You add those 2 groups together, and in that month, you're either above or below 50. You then average up all your months, and if you're above 50, if you're 50 or more, you're subject to the law. Hours for this purpose means hours that you pay somebody for working and non-working time, such as vacations or other leaves of or leave of absence. Now, before we leave this subject, there's one exception that may help some of you if you employ seasonal workers. Under this special rule, when you lay out your chart of the 12 months during 2013 and how many full-time employees and equivalents do I have in each month, if in 8 or more months you had fewer than 50, and in 4 or fewer months you go above 50, but you went above 50 because of your seasonal workers, you can still be exempt from the law. Seasonal workers are workers. We don't have a lot of guidance about this, by the way, so basically it's people who work on a seasonal basis, and you just have to apply a good faith interpretation of what that means. Note that if the reason you went above 50 in 5 months or more is due to seasonal workers, you don't get to take advantage of this special exemption. It only applies if it's for 4 months or less. With that, I'm going to turn it over to Lori to talk about what happens if you don't comply with the law by choice or simply because you failed one of the requirements. Lori?
Thanks, Lee. Applicable large employers who do not comply with the employer shared responsibility rules will be subject to an excise tax. As Lee discussed, an employer is a large employer if it employs, on average, 50 full-time employees and full-time equivalents for the calendar year. It's important to note that though an employer may be part of a controlled group, the tax is applied on a member-by-member basis. If one of my fellow presenters could move to the next slide for me, please. Thank you. To avoid penalties, employers must provide minimum essential coverage to at least 95% of their full-time employees, affordable health coverage, and minimum value coverage. Eric and Belinda will discuss these types of coverages later in the webinar. Next slide, please. The excise tax is triggered when an employer fails to offer minimum essential coverage or affordable health coverage or minimum value coverage, and one of the employer's full-time employees receives a premium tax credit or a cost-sharing reduction when purchasing insurance on an insurance exchange. If no full-time employee is eligible for a premium tax credit or a cost-sharing reduction when they purchase insurance on an insurance exchange, then the excise tax will not apply. An employee will be eligible for a premium tax credit if he or she is between 100% and 400% of the federal poverty level and has purchased insurance on an insurance exchange. So, if an employer is paying all of its full-time employees more than $88,000, none of the employees would be eligible for a premium tax credit. However, if some of the full-time employees are making less than $88,000, these employees might be eligible for the premium tax credit. New slide, please. Thank you. There are two types of excise taxes. An employer's liability will depend on how it failed to comply with the rules. If an employer fails to offer coverage to at least 95% of its employees and their dependents, the excise tax is calculated by taking the number of full-time employees employed for the year and then subtracting 30, and then multiplying this number by $2,000. For purposes of this calculation, a full-time employee does not include full-time equivalents. The 30-employee reduction is applied on a control group basis, with the reduction allocated among the members of the group based on each member's number of full-time employees. If an employer offers coverage for some months but not others during the calendar year, the excise tax is computed separately for each month the employer failed to offer coverage. The monthly calculation is the number of full-time employees employed for the month minus 30 multiplied by 1/12 of $2,000. The payment for the calendar year is the sum of the monthly payments computed for each month the employer failed to offer coverage. Next slide. If an employer does offer coverage to at least 95% of its full-time employees and their dependents, the employer could still be subject to the tax If, for example, the employer did not offer coverage to an employee who then received a premium tax credit for buying insurance on an exchange, or if the coverage the employer offered the employee was either unaffordable to the employee or did not provide minimum value. The tax is calculated separately for each month by taking the number of full-time employees who received a premium tax credit for that month and then multiplying that number by 1/12 of $3,000, or the tax will be the amount of the penalty that would have been imposed under the $2,000 excise tax calculation, whichever is less. This cap ensures that the penalty for employers offering coverage can never exceed the penalty that employers would owe if they did not offer coverage at all. Next slide. Employers will be notified after the end of each calendar year if any of their employees received a premium tax credit or a cost-sharing reduction for purchasing insurance on an insurance exchange. Now, I will turn it over to my colleague Eric to discuss what it means to offer coverage to 95% of employees. Eric?
Thanks, Lori. As Lori discussed, penalties under the shared responsibility rules hinge on whether coverage is offered to an employer's full-time employees and the full-time employees' dependents. As she mentioned, there's two possible penalties for failure to offer coverage to full-time employees. Now, this penalty does only apply to the extent that at least one employee receives a premium tax credit or cost-sharing reduction with respect to coverage purchased on the exchange. The amount of the two penalties may greatly vary. So the failure to offer coverage to at least 95% of full-time employees may end up resulting in a very large penalty because it is based on the number of full-time employees employed by the control group member, including those employees who have been offered coverage. On the other hand, if the employer satisfies the 95% requirement, it may still be subject to penalties with respect to those full-time employees who are not offered coverage. But in this instance, the penalty will just be equal to $3,000 per employee who is not offered coverage and who receives a premium tax credit or cost-sharing reduction. Given this, some employers may elect to pay a penalty in lieu of providing coverage to all full-time employees. For example, some employers may focus on complying with the 95% requirement and then making a business decision as to whether full compliance or payment of the penalty is desirable with respect to certain categories of full-time employees. There's many factors that you're obviously going to consider in this analysis. For example, the penalties are not tax deductible, whereas the cost of providing employer health coverage is. And you also need to consider that if you stop offering coverage to certain employees, whether or not you'll need to make a payment to the excluded employees to compensate them for the cost of purchasing coverage on the exchange. So as I mentioned, the shared responsibility rules require that employers offer coverage to full-time employees and their dependents. The term dependent means an employee's child under age 26. Notably, an employee's spouse is not considered a dependent under shared responsibility rules. This presents a possible planning opportunity. Since there is no penalty for failure to offer coverage to a spouse, an employer can comply with these rules by offering employee plus children coverage to its full-time employees. The definition of full-time employee is requires a little bit more in-depth analysis. A full-time employee is an employee who is employed an average of at least 30 hours of service per week. Now, rather than counting hours of service on a weekly basis, you can count hours of service on a monthly basis, in which case a full-time employee is someone who works at 130 hours of service per month. The proposed regulations use the common law definition of employee. There are certain categories of individuals who are not considered an employee for this purpose, such as independent contractors, leased employees, sole proprietors, partners in a partnership, and 2% S corporation shareholders. However, when you're looking at your different classifications of individuals, you want to look at your workforce to confirm that people classified as independent contractors are truly independent contractors rather than common law employees. So for example, if an individual performs the same tasks as other employees, does not work for any other entity, and does not hold himself out to have his own business, this may raise red flags in the IRS view as to whether this individual should have been classified as a common law employee rather than an independent contractor. So since a full-time employee is someone who works 30 hours of service per week, this obviously raises the question, what is an hour of service? In general, hours of service include each hour that an employee is paid to perform services and each hour for which an employee is paid during certain absences. The method used to calculate an individual's hours of service may differ based on whether they're an hourly employee or a salaried employee. For hourly employees, employers have to count their actual hours. However, for non-hourly or salaried employees, there's three different options. You can count an employee's actual hours, or you can apply one of two equivalency methods. There's a days worked equivalency method under which an employee is credited with 8 hours of service for each day that the employee would be required to be credited with at least 1 hour of service, and a week's worked equivalency method under which an employee is credited with 40 hours of service for each week that the employee would be required to be credited with at least 1 hour of service. Now, you can apply different methods of counting hours of service to different classifications of non-hourly employees, and different controlled group members can use different methods. So just because one entity in your controlled group counts actual hours for their salaried employees doesn't necessarily mean that every other entity needs to do so. The only requirement is that the classifications must be reasonable and consistently applied. The proposed regulations do, however, contain an anti-abuse rule, which simply says that you can't use an equivalency method that would substantially understate an employee's hours of service. So for example, if you had an employee that worked 3 days a week, 10 hours a day, you wouldn't be able to apply the days worked equivalency method to argue that the individual is not a full-time employee. Now this is just for your future reference. This is the definition of hours of service from the proposed regulations. Now obviously the next question is over what period an employee's hours of service are measured to determine whether or not he or she is a full-time employee. So there's two different ways for determining full-time employee status. You can do a monthly determination, or you can use the optional look-back rule, which is contained in the proposed regulations. So if you determine full-time employee status on a month-by-month basis, this would enable employers to move employees in and out of coverage each month. However, a difficulty arises for employees whose full-time status is unclear. For these employees, you may not know whether an employee is a full-time employee until it's too late. And then this will create the risk that you may be subject to the penalties that Lori discussed earlier. In recognition of this problem, as I mentioned, the proposed regulations contain an optional look-back rule to determine full-time employee status. I'll be discussing the mechanics of the look-back rule shortly, and just to let you know, they are very, very detailed and quite lengthy. But when you're deciding whether to make a monthly determination or apply the look-back rule, employers should look at their workforce to determine the best method. So essentially, you're going to have 4 different categories of employees you're going to want to look at. Employees working over 30 hours a week, employees working under 30 hours a week, and then the employees in between, the individuals who may or may not work 30 hours a week, and then those employees who are seasonal employees. As Lee mentioned, we don't really have a firm definition of seasonal employee yet, but you can just apply a good faith interpretation of the term for now. So if you have, in looking at your workforce, if all you have is employees working over 30 hours per week, you have all full-time employees, so you may not necessarily need to apply the look-back rule. On the other hand, if you have a very, very large number of employees who are on the border of the 30 hours per week, that may lean more towards using the look-back rule. It is important to keep in mind the $3,000 penalty versus the $2,000 penalty. So for failure to offer coverage to 95% or failure to offer coverage to just an individual full-time employee. Now, just because an employer has one variable hour employee, so an employee in the in-between that they can't tell whether or not they're a full-time employee, doesn't necessarily mean they need to use the look-back rule. Even if they miss one employee, assuming they offer coverage to at least 95% of their full-time employees, the penalty is going to be $250 a month and will apply to the extent that the employee receives a premium tax credit or cost-sharing reduction on the exchange. So getting into the look-back rule, I'm just going to provide a broad overview of the rule. in this presentation with some examples to try to put these rules in context. But just to let you know, there are some additional aspects of the rule that I won't be fully covering in this presentation. Under the look-back rule, full-time employee status is determined by hours credited during a look-back measurement period to determine whether an employee must be offered coverage during a subsequent stability period. And employers may use an administrative period to notify employees of their eligibility to participate and enroll those employees who elect coverage. Now, I'm going to go into these three concepts in detail as I move forward with this presentation, but the application of the look-back rule will differ depending on whether an individual is an ongoing employee or a new employee. There are also special rules in the proposed regulations for individuals who are rehired or return from an unpaid leave of absence, as well as new employees who have a change in status. So we'll start out with the application of the look-back rule to ongoing employees. An ongoing employee is an employee who has been employed for at least one complete standard measurement period. Standard measurement period is a period of at least 3 but not more than 12 months as selected by the employer, during which an employee's hours are measured to determine if he or she is a full-time employee. Now, an employer may choose its measurement period within these parameters. For example, an employer may decide to measure hours based on a calendar year, or you could pick any other period of time that complies with these rules. So if you wanted to measure hours between March and October, you could do so as long as you fit within these parameters. However, the same measurement period does need to apply to all employees in the same category. Now, however, for different categories of employees, for certain categories of employees, you may apply different measurement periods. So you can have different measurement periods for each group of union employees covered by a different collective bargaining agreement, union and non-union employees, salaried and hourly employees, and employees whose primary places of employment are in different states. Now, you're going to look at the hours worked during the measurement period to determine whether an employee is treated as a full-time employee during a subsequent stability period, without regard to the employee's hours worked during that stability period. In general, for most employers, the length of the stability period is going to be equal to the length of the standard measurement period. The proposed regulations do contain a rule that if an employee is treated as a full-time employee, the stability period must be at least 6 months. So practically speaking, many employers may want to use a 6-month measurement period since the stability period may be required to be 6 months for certain employees. In fact, I expect that many employers may want to use a 12-month stability period. And in recognition of the fact that employers may not have systems set up yet to count hours of service and determine full-time employee status, there's a special transition rule that allows employers to use a 12-month stability period if they use a measurement period of at least 6 months that starts no later than July 1st, 2013 and ends no earlier than 90 days before the start of the 2014 plan year. So just an example to give you a little context. An employer could apply a measurement period spanning from April 15th, 2013 through the end of the year to determine whether an employee will be considered a full-time employee during a 12-month stability period beginning January 1st, 2014. However, the problem with my example is that having the stability period immediately after the measurement period may not really be practical because employers will not have sufficient time to determine who are the full-time employees and offer such employees an opportunity to enroll in coverage. And in recognition of this, the IRS permits employers to use an administrative period, similar to open enrollment period that people use now for their plans, of up to 90 days between the standard measurement period and the start of the stability period to notify and enroll employees. The administrative period must overlap with the prior stability period and cannot reduce or lengthen the measurement or stability period. Essentially, this just means that an administrative period cannot result in a gap in coverage. So kind of going back to my example and revising it a little bit, an employer might choose a measurement period of March 15th, 2013 through October 14th, 2013 to determine who is a full-time employee for the 2014 calendar year. they could also use the period of October 15th through the end of the year as their administrative period to notify and enroll employees. And then next year, they could apply an administrative period from October 15th, 2014 through the end of the 2014 year, which will overlap with the 2014 stability period, which ends December 31st, 2014. So I'm just going to run through a couple examples just to kind of clarify these rules a little bit more. So ABC Corporation has over 500 employees and limits coverage to employees classified as full-time employees under the look-back rule. ABC Corporation uses a 12-month standard measurement period beginning October 15th to determine employees that will be offered coverage during the next 12-month stability period, which is the calendar year. ABC Corporation also uses the period of October 15th through December 31st to notify and enroll employees in coverage. So in example 1, Alan is hired on April 1st, 2002. After reviewing Alan's hours from October 15th, 2014 through October 14th, 2015, that's the measurement period, ABC Corporation determined that Alan worked, on average, 30 hours of service per week. Now, since Alan was a full-time employee during the measurement period ending October 14th, October 14th, 2015, he must be offered coverage during the 2016 calendar year. Now, assume that ABC Corporation again measures Alan's hours during the measurement period ending October 14th, 2016, and determines that he only worked 28 hours per week during this measurement period. Now, in this instance, Alan will not be treated as a full-time employee and does not need to be offered coverage during the 2017 calendar year. However, ABC Corporation must continue to offer Alan coverage through the end of the 2016 calendar year, which is the stability period corresponding with the standard measurement period ending October 15th, 2015. Now, as I mentioned, the application of the shared responsibility rules differ for individuals who are new employees. A new employee is an employee that has not been employed for at least one standard measurement period. So when an employer hires a new employee, they'll need to determine whether the new employee is a full-time employee, a variable hour employee, or a seasonal employee. A full-time employee is an employee who is reasonably expected to be employed on average at least 30 hours per week during the measurement period and is not a seasonal employee. A variable hour employee are those employees I discussed earlier who are in between. So you can't determine whether or not they're going to work 30 hours per week. Now, there is a special transition rule for 2014 for short-term employees. And under this rule, employers may consider whether an employee is likely to terminate employment during the initial measurement period in determining whether an employee is expected to be employed on average 30 hours per week during the measurement period. So, for example, assume an employee is expected to work 40 hours per week for 6 months during their initial measurement period. If the employer uses a 12-month measurement period, the employee will not be considered a full-time employee under the transition rule because the employee is scheduled to work, on average, 20 hours per week during the measurement period. However, beginning January 1st, 2015, unless the employee is a seasonal employee, employers cannot take into account the likelihood that the employee's employment will terminate before the end of the initial measurement period. So in the example I just gave, the employee would be considered a full-time employee unless he fell within the definition of a seasonal employee, which, as Lee mentioned, there's not a lot of guidance on that yet, so you can just use the good faith interpretation. So why do these classifications matter? The initial measurement period and stability concepts only apply if an individual is a variable hour or seasonal employee. They will not apply if an individual is a new full-time employee. Now, to the extent an individual is a new full-time employee, an employer must offer coverage to such employee at or before the conclusion of the employee's 3 initial full calendar months of employment. And if an employer fails to do so, it may be subject to a penalty for those 3 months, as well as any subsequent months that coverage isn't offered. On the other hand, an employer does not need to offer coverage to variable hour and seasonal employees during the initial measurement period. This may allow an employer to delay offering coverage to these employees for over 1 year through application of the look-back rule. Now, just like ongoing employees, applying the look-back rule to new employees involves the use of a measurement period, stability period, and optional administrative period. Many of these rules are very similar or the same as ongoing employees, but there are a few differences to note. First, the measurement period for new employees is called the initial measurement period. The initial measurement period is a period of 3 to 12 months beginning on any date between the employee's start date and the first day of the month following the employee's start date. Now, this period must be the same length as the standard measurement period, but the actual period may vary based on the employee's date of hire. So, for example, an employer using a 12-month standard measurement period has to use a 12-month initial measurement period. So if the employee was hired 1 year from today, their initial measurement period may span from February 26, 2014 through February 25, 2015. And as I mentioned, they could also choose to start the measurement period on March 1st if they so desired. And as I noted on the slide, some of the rules I previously discussed in the context of ongoing employees will also apply to new employees. Now again, just like for ongoing employees, the hours worked during the initial measurement period will determine whether an individual is treated as a full-time employee during the subsequent stability period, without regard to hours worked during the stability period. Now, in general, again, the length of the stability period is going to be equal to the length of the standard measurement period for most employers. However, if an employee is treated as a full-time employee, again, the standard measurement period must be at least 6 months. In addition, if an employee is not treated as a full-time employee, the stability period cannot be more than 1 month longer than the initial measurement period and cannot exceed the remainder of the standard measurement period plus any associated stability period. Put differently, an employee has to be remeasured at the end of the standard measurement period, even if that period overlaps with the initial measurement period. For example, assume an employee was hired as a variable hour employee a year from today, and the employer uses a 12-month initial measurement period and a standard measurement period based on the calendar year. If, to the extent an employee is not determined to be a full-time employee during the initial measurement period, the employer will need to look at the individual's hours during the 2015 calendar year, which is the 2015 standard measurement period, to determine whether the individual is a full-time employee under the ongoing employee look-back rule. And I'll discuss another example applying this concept in a few slides. Again, just like ongoing employees, employers may use an administrative period of up to 90 days to notify and enroll employees. Now, for new employees, the administrative period includes the entire period between the employee's start date and the date the employee is first offered coverage, other than the initial measurement period. This means that if the initial measurement period begins on the first day of the month after an employee's date of hire, the period between the start date and the first of the month must be taken into account in applying the 90-day limit. In addition, the initial measurement period and administrative period combined may not extend beyond the last day of the first calendar month beginning on or after the 1-year anniversary of the employee's start date. So I'm going to run through a few examples applying the look-back rule and these concepts that I've discussed to new employees. So assume ABC Corporation uses a 12-month initial measurement period that begins on the employee's start date and applies an administrative period from the end of the initial measurement period through the end of the first calendar month beginning on or after the end of the initial measurement period. So in the first example, Bob is hired by ABC Corporation on February 26, 2014. At the time Bob is hired, ABC Corporation reasonably expects that he will work, on average, 40 hours per week during the measurement period. Now, since Bob is considered a new full-time employee, the look-back rule concept does not apply, and ABC Corporation must offer health coverage to Bob prior to June 1st, 2014. And this is based on the rule I discussed earlier that employers must offer coverage to new full-time employees on or before conclusion of their 3 initial full calendar months of employment. Now let's look at example 2. Carl is hired by ABC Corporation on February 26, 2014 as a variable hour employee. During his initial measurement period, Carl works on average 30 hours per week. Now, since Carl worked at least 30 hours per week during his initial measurement period, he will be treated as a full-time employee during the corresponding stability period of April 1st, 2015 through March 31st, 2016. Now, in order to avoid possible penalties, ABC Corporation will need to offer Carl coverage during this period. So I'm also going to discuss another example which shows the transition of an individual going from a new employee to an ongoing employee. So assume that ABC Corporation again measures Carl's hours during the measurement period ending October 14, 2015, so the next measurement period, and determines that Carl only worked 25 hours per week during that period. In this instance, ABC Corporation must continue to offer Carl coverage through March 31st, 2016, which is the end of the stability period corresponding to Carl's initial measurement period. However, ABC Corporation does not need to offer Carl coverage during the period of April 1st, 2016 through December 31st, 2016. As I mentioned before, the proposed regulations also contain a special rule for new employees who have a change in status. In the interest of time, I'm not going to discuss this rule, but the next 2 slides set forth the rule and provide an example. These concepts are also discussed in detail in a newsletter that's available on Foley.com. If you can't find the newsletter on Foley.com, or if you just don't feel like looking for it, feel free to send me an email to ask for a copy. My contact information is listed at the end of the slides. There's also another special rule for returning employees, so employees returning from a break in service. And this is going to be your rehires and employees returning from an unpaid leave of absence. So an employer may treat these employees as a new employee if the employee incurs a 4-week break in service and either the break in service is at least 26 weeks long or the break in service is longer than the employee's period of employment immediately prior to the break in service. Otherwise, the employer is required to treat the returning employee as an ongoing employee. Now, the relevance of that is that in the event a returning employee is treated as an ongoing employee, the employee will retain the status that the employee had with respect to any remaining stability period. So, for example, if an employee returns during a stability period in which the employee is treated as a full-time employee, the individual will be treated as a full-time employee upon their return to employment and through the end of that stability period. And in this case, so if they're treated as a full-time employee, they have to be offered coverage on their date of rehire or as soon as administratively practical thereafter. Now, there's also some special rules which apply for determining an ongoing employee's full-time status upon return from certain leaves. I'm not going to go into detail on this rule, but again, this is discussed in the article, which is available on Foley.com. So an example applying the look-back rule to returning employees. So as of April 1st, 2015, Ed had been employed by ABC Corporation for 10 years. Ed terminates employment on April 1st, 2015, and is rehired on December 1st, 2015. Now, since Ed's break-in service was longer than 26 weeks, he may be treated as a new employee for purposes of determining Ed's full-time employee status. Now, as I mentioned, employers may be subject to penalties for failing to offer coverage to its full-time employees and their dependents. The determination of who is a full-time employee is somewhat complicated under the look-back rule, and as I've detailed, it's very, very complex, and there's a lot of rules. So I encourage you to contact your ERISA attorney to the extent you have any questions about the application of these rules. I'm now going to hand over the presentation to my colleague, Belinda Morgan, who is going to discuss the penalties that may apply in the event an employer offers coverage which is either unaffordable or does not provide minimum value.
Thanks, Eric. As Lori and Eric explained, large employers that fail to offer their full-time employees and their dependents the opportunity to enroll in minimum essential coverage, or who fail to offer that opportunity to a sufficient number of employees and dependents, may be subject to a shared responsibility excise tax. However, even if a large employer offers its full-time employees and dependents that coverage,
the employer could still be subject to an excise tax penalty depending on the cost of the coverage offered and the value that it provides to those employees. Under the shared responsibility rules, employers that offer minimum essential coverage to their employees and dependents will still be subject to the $3,000 excise tax that Lori mentioned if the employer-provided coverage either fails to provide minimum value or is unaffordable to the employees, and as a result, one or more full-time employees purchase subsidized coverage from one of the insurance exchanges. And in this case, by subsidized, what I mean is that they are receiving some sort of premium tax credit or other cost reduction, as Lori mentioned, to purchase the coverage from the exchange. So if an employer must provide its employees with minimum value coverage to avoid the penalties, what exactly does that mean? Essentially, the minimum value determination looks at how a non-grandfathered plan's overall costs are divided between the employer and the plan's participants. An employer-provided plan will have minimum value if the plan's share of the total allowed cost of benefits that are provided under the plan is at least 60% of those costs. The cost of benefits will include the amount of copays, the deductibles, and the out-of-pocket maximums that employees are required to pay. Now, obviously, this is not going to be an easy determination for employers to make. So the IRS and the Department of Health and Human Services have created what they're calling a minimum value calculator to assist employers in determining whether or not their plans offer minimum value to participants. And it can be found at the website that's listed there on the slide. To use the calculator, employers will be expected to input certain information about their plans, such as the deductibles, copays, and out-of-pocket maximums that I mentioned, into the calculator. The calculator will then determine the value of the employer's plan based on these inputted amounts, and then determine whether or not it provides at least 60% value as required. As an alternative to using the minimum value calculator, the IRS and the Department of Health and Human Services have also mentioned that they'll offer an array of safe harbor checklists that employers could use to compare their plan's coverage to. And what it's thought that these will do is that the checklist will include a number of different plan features, and so long as the terms of the employer's plan are consistent with or perhaps more generous than the features that are listed on the checklist, the plan will be treated as providing minimum value. At this point, though, the departments have not yet issued any such checklist. So finally, if an employer's plan has such non-standard features that neither using the minimum value calculator or one of these checklists to determine whether or not it provides minimum value would be very accurate, employers may engage professional actuaries to actually determine whether or not their plan meets minimum value requirements. In addition to providing minimum value, and in order to avoid the $3,000 excise tax penalty, an employer's health plan must also be affordable to its employees. Under the Affordable Care Act, coverage under the employer's plan is deemed to be affordable if the employee's required contribution for the coverage does not exceed 9.5% of the employee's household income. This test for affordability applies to the cost of self-only or individual coverage. Now, there's no practical way for an employer to actually know what the employee's total household income is, though. The employee could have different sources of additional income that the employer is not aware of, such as income from a second job, or there may be income that's being brought in by the employee's spouse or children, et cetera, that would all be included in household income. Recognizing the difficulties that employers may face in trying to determine whether or not their plans are affordable based on household income, the IRS has provided 3 safe harbor methods for determining affordability under the employer shared responsibility rules. The safe harbors rely on criteria other than the household income to determine affordability, and that's going to be criteria that, in contrast to an employee's household income, will actually be available to employers. Employers that meet the requirements of any of these safe harbors will be deemed to offer affordable coverage to their employees and the dependents of those employees. Use of the safe harbors is optional for employees or for employers, but really as a practical matter, due to the issues involved in determining household income, most employers are likely to use one or more of these safe harbors. In order to use one of the affordability safe harbors, an employer will need to offer its full-time employees and dependents the opportunity to enroll in minimum essential coverage under one of the employer's group health plans, and will also need to offer coverage that provides minimum value for the self-only coverage. And these requirements make sense because if they aren't met, whether the employer satisfies the affordability safe harbor really won't matter. The employer will be subject to one of the employer shared responsibility excise tax penalties in any case. Employers may use any of the safe harbors that are provided by the IRS for any reasonable category of employees, so long as they apply the safe harbor on a uniform and consistent basis for all employees in that particular category. So, for example, an employer could use one safe harbor for its hourly employees while using another for salaried employees, so long as the employer's use of the safe harbor is consistent with respect to each group. In addition, employers could presumably elect to change the safe harbors that they use from year to year, again, so long as they're consistent in that usage. The benefit of using one of the safe harbors to determine affordability is that if, based on the employer's use of a safe harbor, an employee's coverage is deemed to be affordable, the employer will not be subject to the $3,000 excise tax penalty. And that'll be the case even if the employee would nevertheless qualify for a premium tax credit or a cost reduction based on the employee's actual household income, and if the employee then went out and bought subsidized coverage on an insurance exchange. The employer would still not be subject to the excise tax since using the safe harbor, the employer's coverage is deemed to be affordable. The first affordability safe harbor is based on the employee's Form W-2 wages. Under this safe harbor, the employer's coverage will be deemed affordable with respect to any employee if the employee's required contribution for the calendar year for self-only coverage again is not more than 9.5% of the employee's Form W-2 wages. And these are the taxable wages reported in Box 1 of Form W-2. So there are a few things that employers will need to consider when they're deciding whether or not to use this particular safe harbor. First, employees' Form W-2 wages are determined at the end of the year and on an employee-by-employee basis. So this means that the employer will need to make an educated guess as to whether or not an employee's overall contribution during the year will exceed that 9.5% of the employee's final taxable income at the end of the year, and so make any adjustments accordingly at the beginning of the year. Employers will also need to keep in mind that because only Form W-2 Box 1 wages are considered in the safe harbor, non-taxable employee benefits like pre-tax contributions to 401k plans and cafeteria plan contributions can't be considered when determining an employee's overall contribution. In addition, an employee's required contribution, whether as a specific dollar amount or as a percentage of Form W-2 wages, has to remain consistent throughout the year. This could result in coverage that's deemed to be unaffordable in some instances if the employer is not careful. And as an example of that, assume you have an employer that sets the employee's contribution at 9.5% of wages during the year, estimating the overall contributions based on the employee's prior year W-2 wages. If during the year the wages of the employee drop for some reason, maybe because the employee voluntarily elects to decrease the number of hours they're working, or for whatever reason, that could result in the employee paying more for their coverage than the 9.5% that the employer had estimated. To avoid that possibility, employers may want to consider whether it is worthwhile to true up an employee's wages at the end of the year to ensure that the employee's contribution never exceeds 9.5% of wages. And this would seem to be permitted under the safe harbor, but it would be great to get additional information from the IRS and Health and Human Service verifying that. Finally, there's a special rule that allows the use of the W-2 wages safe harbor for employees who are not full-time for an entire year. And then implying the safe harbor in that case, the wages for the employee would just be adjusted to reflect the period during which the employee was considered full-time. The second safe harbor relies on the employee's projected monthly rate of pay over the calendar year. With this safe harbor, so long as the employee's contribution for self-only coverage doesn't exceed 9.5% of the employee's monthly rate of pay, the coverage is deemed affordable. The rate of pay used for this safe harbor is the employee's rate of pay at the beginning of the year. So unlike the W-2 wages safe harbor, which has to be applied at the end of the year, this safe harbor is easier to apply prospectively for employers. In determining an employee's monthly rate of pay, for hourly employees, it's just the hourly rate of pay multiplied by 130. For salaried employees, it's the monthly rate of pay that's used. It's simply the monthly salary. Once the employer has determined an employee's monthly rate of pay, it just needs to determine whether the employee's required contributions for the health coverage exceed 9.5% of that amount. And again, it's for self-only coverage. Keep in mind that the safe harbor applies with respect to an employee's rate of pay at the beginning of the year. So if the employee gets a raise during the year or somehow other contributions or compensation is paid to the employer cannot increase the employee's contributions for health care based on the increase in pay. The employee's contribution has to remain the same throughout the year. In addition, another requirement for using the safe harbor is that the employer isn't permitted to reduce an employee's hourly wages or salary during the year. So this will reduce any sort of flexibility the employer might have to reduce wages or salaries in order to deal with financial difficulties it might encounter during the year. In addition, it's not entirely clear how the employer would apply the safe harbor in situations where an employee voluntarily takes a pay reduction. For instance, where an employee elects to move from a full-time position to a reduced hour position, but one that still allows the employee to have health coverage. Hopefully, we'll get more guidance from the agencies on this issue as well in the future. And the final safe harbor is the federal poverty line safe harbor. With this safe harbor, the employer's coverage is deemed to be affordable so long as the employee's required monthly contribution, again, for self-only coverage, does not exceed 9.5% of the federal poverty level for a single individual divided by 12, and divide by 12 so that the poverty level is determined on a monthly basis. Employers must use the federal poverty limit that applies for the state in which the employee is actually employed. But for most employers, this will be a fairly standard calculation because there's a single poverty limit that applies for all 48 continental states as well as the District of Columbia, with a separate, somewhat higher limits that apply for both Alaska and Hawaii. So long as an employer has employees in, even if they have employees in a number of states, but so long as it's not Hawaii or Alaska, the employer would be able to use the same limit for all of its employees. Employers are permitted to use the poverty guidelines that are in effect in the beginning of the plan year, even if those limits are changed later in the year. So because of this, in many cases, the same limit will apply for all of an employer's employees. And as a result, the poverty level safe harbor may be the easiest safe harbor for employers to apply. The key here, though, is whether or not the amounts that can be charged to employees using the safe harbor will really be sufficient to meet the employer's costs in providing health coverage. For instance, the current federal poverty limit for the 48 continuous states in D.C. is just $11,490, or about $958 a month. Using this amount and applying the 9.5% limit, the maximum employee contribution for self-only coverage would be about $91 per month, and it may be that many employers are already charging more than that for the coverage to their employees. So that's it for the safe harbors and affordability, and now I'm going to turn it back over to Lee for a discussion of how employers should assess the impact of the employer shared responsibility rules on their businesses and the issues they should consider in complying with those new rules. Lee?
Thanks. For those of you who've been waiting for your New York and New Jersey CLE code, please pick up your pens because I have it right now. It is 3ZWCC. Again, that's 3Z as in Zulu, W as in whiskey, C as in Charlie, C as in Charlie. Okay, I'm sorry we're going over time, so we'll spend about 5 more minutes kind of wrapping everything up and discussing what do you do with all this information that we've given you? How do you approach this new law? As Eric mentioned, the first thing you need to do is a cost-benefit analysis. How many employees are considered full-time employees under this law that I currently don't offer coverage to? And if I did offer coverage to them, how much is that going to cost from my health plan's perspective, especially if I'm only charging 9.5% of something, one of the 3 safe harbors, for employee-only coverage. And so you look at all the costs of that and you weigh it against the penalty costs. Now, when you do this, keep in mind that you don't necessarily have to offer the plans you currently provide. Maybe your current health plan is a gold standard, really wonderful, really rich plan that covers 90% of benefits on average. Well, remember, the law only requires you to provide a 60% value plan. So as you're doing your cost-benefit analysis, think about if I added a 60% plan option and that became my employer shared responsibility option that I have to offer, maybe that's going to change the cost to make it affordable. What do you do, though, if after you look at this, you say, I can't afford this? This adding these people to my coverage or reducing their premiums to 9.5%, that's just not going to be affordable to me. Then you've got to look at mitigation. What do I do to reduce my exposure to the law? For example, my variable hour employees, can I schedule them so that nobody ends up being more than 30 hours a week? They never qualify as a full-time employee in the first place. If I do this, think about making sure that you rewrite your job descriptions to make that clear. Also, if you're trying to manage your employees' hours, be careful about ERISA 510. ERISA 510 is a provision that says it's unlawful for an employer to discharge, suspend, or discriminate against a participant for either exercising their rights or interfering with their attainment of rights. So if, for example, you've got somebody and you're measuring their hours and you're keeping a good eye on it, and as they're getting to the end of their measurement period, you go, I think they're going to go over 30, so I'm just going to cut their work. I'm going to tell them just go home, don't come back for 2 more months because, otherwise you're going to be a full-time employee that I have to offer coverage to. Or maybe I'll fire them. If you do anything like that, you got to be careful about this ERISA 510 issue because you might be subject to a lawsuit. Should you lease more workers? This rules only apply to common law employees, and so maybe we need to shift the workforce to a leasing company. But if you do that, as Eric mentioned, you had better be really darn sure that those leased employees are truly leased employees and they're not your common law employees. Then you deal with the practical stuff. What if you are going to comply with the law? You got to figure out all those decisions that we've talked about. What's our measurement period? Should we use a 12-month measurement period? In our opinion, yes. If you've got a lot of seasonal or variable employees, you want to pick a long measurement period, that 12 months, that's your longest, to kind of keep them out of the plan as long as you possibly can, but also to give you the maximum time period to allow them to average out at less than 30. You're going to have to do a lot of coordination with your payroll, either your vendor or your group within your company, because hours of service, as you've seen, are so critically important to this law, and tracking them appropriately is important. You're going to have to rewrite a lot of documents. Your summary plan descriptions, your enrollment materials, anything related to your health plan is probably all going to have to be redone to talk about these full-time employees and what's our measurement period and how long are you going to be treated as a full-time employee for purposes of our health plan, keeping in mind that all of these rules only apply to your health plan and don't affect your disability plans, your life insurance plan, and everything else. Finally, think about what would I do if I got a letter from the IRS that said one of my employees has bought coverage on the exchange, they got a premium credit for it, and the IRS then says, employer, why shouldn't I assess a penalty against you for this full-time employee? You need to be prepared to respond to that. Hey, IRS, that person is not a full-time employee. Here's how I can prove that. Or maybe they were a full-time employee. I did offer them coverage, and for whatever reason they declined it. That's not my problem. I did what the law required. But how are you going to prove that you actually offered coverage to that person? You probably right now don't make anybody that declines coverage sign a form. Probably with this new law, you should, because that'll be your way to prove to the IRS that you identified that person as a full-time employee and you offered them coverage, and here's their signature where they declined it. So that's just some of our tips and thoughts for you to deal with this new law. Our contact information of your 4 speakers is on this slide. If you have any questions, contact us or any of your other Foley lawyers. And a copy of this PowerPoint presentation and a recording is going to be available within the next 24 to 48 hours on Foley's website. And we do always love your feedback and any information you want to get back to us about future topics for discussion. And on the right-hand side of your screen, you should see something called SurveyMonkey, and that's where you go to do the survey. Thank you all, and have a great rest of your day.
Once again, we'll conclude our conference call for today.